Legend has it the term money laundering dates back to the time of Al Capone. The notorious Chicago gangster is said to have bought up a string of laundrettes in the 1920s to disguise his illicit earnings. In reality, the practice has indeed existed for decades, but the term only came into official use in the 1980s. Criminals earning huge sums of money from drug trafficking, weapons smuggling and extortion need to show a legitimate source for their income in order to dodge the police and tax authorities. So they embark upon a so-called laundering process made up of 3 stages. The first, filtering. Black market deals are often paid in cash, which is divided up into smaller sums to avoid any large and conspicuous bank deposits. Each stash is given to a frontman. The money can be banked, gambled away on casinos, lotteries and sports bets, or invested in precious metals and luxury goods. The second step is all about camouflage. The money has to exchange hands enough times for its origin to become untraceable. Often it's channeled into tax havens known for their less vigorous checks or filtered through fake companies. By purchasing an outwardly respectable business, criminals are able to obtain the relevant receipts to make everything look legitimate. Casinos, hotels, restaurants and nightclubs are popular choices as they generate high levels of cash flow. The final step involves putting the money into mainstream circulation by investing in the luxury property market, making financial investments or buying art. The extent of money laundering on today's global economy is hard to assess, but the International Monetary Fund estimates between 2 and 5% of world GDP is linked to black market activity.